Welcome to Fuzail Pro. You are just 5 steps away to crack the exam. Have a quick cakewalk. Step 1. Financial Management. Key Topics. 1. Value and Returns. 2. Time Preference for Money. 3. Valuation of Bonds and 4. Valuation of Shares. 5. Risk and Returns. 6. Capital Budgeting. 7. Nature of Investment. 8. Evaluation. 9. Comparison of Methods. 10. Risk and Uncertainty Analysis. 11. Dividend. 12. Theories and 13. Determination. 14. Mergers and Acquisition. 15. Corporate Restructuring. 16. Value Creation. 17. Merger Negotiations. 18. Leveraged Buyouts. 19. Takeover. 20. Portfolio Management. 21. CAPM, APT. 22. Derivatives. 23. Options. 24. Option Payoffs. 25. Option Pricing. 26. Forward Contracts. 27. Future Contracts. 28. Working Capital Management. 29. Determinants. 30. Cash. 31. Inventory. 32. Receivables. 33. Payables Management. 34. Factoring. 35. International Financial Management. 36. Foreign Exchange Market. Step 2. Financial Management. Introduction. Investment value is the amount of money an investor would pay for a property. It refers to an asset's specific value based on certain parameters. It is an individual's measurement of the asset's property value. Return is a profit on an investment. It comprises any change in value of the investment, and/or cash flows which the investor receives from the investment, such as interest payments or dividends. It may be measured either in absolute terms, example dollars, or as a percentage of the amount invested. Time value/preference of money is the idea that there is greater benefit to receiving a sum of money now rather than an identical sum later. It is founded on time preference. Valuation of bonds and shares. Risk refers to the variability of possible returns associated with a given investment. Risk, along with the return, is a major consideration in capital budgeting decisions. The firm must compare the expected return from a given investment with the risk associated with it. Capital budgeting, and investment appraisal, is the planning process used to determine whether an organization's long-term investments such as new machinery, replacement of machinery, new plants, new products, and research development projects are worth the funding of cash through the firm's capitalization structure, debt, equity, or retained earnings. It is the process of allocating resources for major capital, or investment, expenditures. One of the primary goals of capital budgeting investments is to increase the value of the firm to the shareholders. The investment decisions of a firm are generally known as the capital budgeting, or capital expenditure decisions. The firm's investment decisions would generally include expansion, acquisition decisions would generally include expansion, acquisition, modernization, and replacement of the long-term assets. Investment evaluation is the twofold task of balancing investment risk against anticipated return. When evaluating an investment, emphasis should be laid on the question, will the expected return justify the risk, rather than on what is the rate of return. We can project the client's sources and applications of funds for the upcoming time periods. Investment criteria of capital budgeting. The investment criteria are: 1. Accounting or average rate of return method. 2. Payback period. 3. Discounted cash flow techniques. 4. Net present value method. 5. Internal rate of return or yield method. 6. Profitability index, PI, or benefit cost ratio. 7. Terminal value, TV, method. Since risk analysis is costly, it should be used relatively in costly and important projects. Risk and uncertainty are quite inherent in capital budgeting decisions. Future is uncertain and involves risk. The projection of probability of cash inflows made today is not certain to be achieved in the course of future. Dividend is the distribution of some of a company's earnings to a class of its shareholders, as determined by the company's board of directors. Dividends are payments made by publicly listed companies as a reward to investors for putting their money into the venture. Dividend determinants: earnings are either retained and reinvested in the company or are paid out to shareholders. Theories of dividend in financial management have been advanced on the relationship between dividend and the value of the firm. One Walter's model: the choice of dividend policies almost always affects the value of the enterprise. His model shows clearly the importance of the relationship between the firm's internal rate of return, R, and its cost of capital, K, in determining the dividend policy that will maximize the wealth of shareholders. 2 Gordon's model: the market value of a share, PQ, is equal to the present value of an infinite stream of dividends to be received by the share. 3 Modigliani and Miller's hypothesis: dividend policy of a firm is irrelevant as it does not affect the wealth of the shareholders. They argue that the value of the firm depends on the firm's earnings which result from its investment policy. Merger refers to an agreement. It is a mutually binding contract in which 2 companies join together to form one company. In other words, a merger is the combination of 2 companies into a single legal entity. Acquisition is when one company purchases most or all of another company's shares to gain control of that company. Purchasing more than 50% of a target firm's stock and other assets allows the acquirer to make decisions about the newly acquired assets without the approval of the company's shareholders. Corporate restructuring is an action taken by the corporate entity to modify its capital structure or its operations significantly. Generally, corporate restructuring happens when a corporate entity is experiencing significant problems and is in financial jeopardy. Value creation for shareholders, in the form of increases in stock price, ensures the future availability of investment capital to fund operations. From a financial perspective, value is said to be created when a business earns revenue, or a return on capital, that exceeds expenses, or the cost of capital. Merger negotiations is the negotiation process conducted for the merger or joining of 2 companies into a single business entity, or the outright purchase of a company by another company. Leveraged buyout, LBO, is the acquisition of another company using a significant amount of borrowed money to meet the cost of acquisition. The assets of the company being acquired are often used as collateral for the loans, along with the assets of the acquiring company. Takeover. Portfolio management is the art and science of selecting and overseeing a group of investments that meet the long-term financial objectives and risk tolerance of a client, a company, or an institution. The CAPM, Capital Asset Pricing Model, lets investors quantify the expected return on investment given the risk-free rate of return, expected market return, and the beta of an asset or portfolio. The ABT, arbitrage pricing theory, is an alternative to the CAPM that uses fewer assumptions and can be harder to implement than the CAPM. Derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets, a benchmark. Options are financial derivatives that give the buyer the right to buy or sell the underlying asset at a stated price within a specified period. It is the profitability of the option under different price conditions. There is a strike price at which you buy the option and that becomes the reference for evaluating your option payoff. The call option payoff formula is nothing but the simulation of the option profitability under different price circumstances. Option pricing theory uses variables, stock price, exercise price, volatility, interest rate, time to expiration, to theoretically value an option. Essentially, it provides an estimation of an option's fair value which traders incorporate into their strategies to maximize profits. Forward contract is a customized contract between 2 parties to buy or sell an asset at a specified price on a future date. A forward contract can be used for hedging or speculation, although its non-standardized nature makes it particularly apt for hedging. Futures contract, sometimes called futures, is a standardized legal agreement to buy or sell something at a predetermined price at a specified time in the future, between parties not known to each other. Working capital management is a business strategy designed to ensure that a company operates efficiently by monitoring and using its current assets and liabilities to the best effect. A company's working capital is made up of its current assets minus its current liabilities. Determinants working capital are items that have a direct impact on the amount invested in current assets and current liabilities, like credit policy, growth rate, payables payment terms, production process flow and seasonality. Cash indicates the company's current assets, or any assets that can be turned into cash within 1 year. A company's cash flow statement shows all incoming cash, such as net income, and outgoing cash used to pay expenses such as equipment and investments. Inventory is the term for the goods available for sale and raw materials used to produce goods available for sale. Inventory represents one of the most important assets of a business because the turnover of inventory represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. Receivables, also referred to as accounts receivable, are debts owed to a company by its customers for goods or services that have been delivered or used but not yet paid for. Accounts payable management is one of the important business processes that help in managing payable obligations of the entity in the most effective manner. Accounts payable is the amount that the entity has to pay to its suppliers or vendors on the account of goods and services received. Factoring is a financial transaction and a type of debtor finance in which a business sells its accounts receivable, i.e., invoices, to a third party, called a factor, at a discount. A business will sometimes factor its receivable assets to meet its present and immediate cash needs. International financial management, also known as international finance, is the management of finance in an international business environment, that is, trading and making money through the exchange of foreign currency. Foreign exchange market, also known as Forex, FX, or the currency market, is an over-the-counter, OTC, global marketplace that determines the exchange rate for currencies around the world. Participants are able to buy, sell, exchange and speculate on currencies. Step 3. Financial Management, MCQs. 1. If the present value of cash inflows are greater than the present value of cash outflows, the project would be A. Accepted. B. Rejected with condition. C. Rejected with approval. D. Rejected. Answer, A. 2 finance functions are A. Planning for funds. B. Raising of funds. C. Allocation of resources. D. All of the above. Answer, D. 3. Match the following. List I, type of value, list 2, features. A. Fair value 1. Shares. B. Replacement value 2. To set up a new plant. C. Value of image 3. Goodwill. D. Market value 4. Consumable items. 5. Wastage. A. 1432. B. 1234. C. 3124. D. 1435. Answer, B. For assertion, A. Special rules and procedures are followed in the import and export trade. Reason, R. The need for import and export trade is explained by the principles of comparative cost theory. A. Both A and R are true and R is the correct explanation of A. B. Both A and R are true but R is not a correct explanation of A. C. A is true but R is false. D. A is false but R is true. Answer, B. 5. Match the following. List I, items, list 2, part. A. Dividend 1. Portion of current assets. B. Stock 2. Fixed liabilities. C. Reserve 3. Portion of profit. D. Depreciation 4. Surplus. 5. Charge against profit. A. 1 2 3 4. B. 1 4 3 2. C. 3 1 4 5. D. 3 1 4 2. Answer, C. 6. The relationship between the cost of equity and financial leverage in accordance with Proposition 2 can be expressed by A. R equals equity / 100. B. R equals equity / debt x 100. C. Re equals R0 plus R0, RD, 1, TC. D. R equals equity / income. Answer, C. 7. The call option value of a callable bond is likely to be high when A. Interest rates are volatile. B. Interest rates are low and expected to remain low. C. Interest rate is high and expected to remain high. D. Markets are inefficient. Answer, A. 8. A project's profitability index is equal to the ratio of a project's future cash flows to the project's A. Present value, initial cash outlay. B. Net present value, initial cash outlay. C. Present value, depreciable basis. D. Net present value, depreciable basis. Answer, A. 9. Earning yield computed by A. EPS / current market price per share. B. Paid up value of share / 100. C. EPS / profit x 100. D. EPS / market price. Answer, A. 10. Match the following. List items, list 2, features. A. Capital budgeting decision 1. Fixed assets. B. Cash position ratio 2. Liquid ratio. C. EOQ 3. Inventory control. D. Cost of capital 4. Issue expenses. 5. Planning. A. 5143. B. 3142. C. 1234. D. 1324. Answer, C. 11. Match the following. List I. Functions of treasurer, list 2, elements. A. Cash management 1. Cash reserve ratio. B. Credit management 2. Average collection period. C. Security 3. Safe custody. D. Financial planning 4. Capital structure. 5. Cost. A. 1234. B. 2314. C. 3142. D. 1423. Answer, A. 12. The present value of all inflows are cumulated in A. Order of investment. B. Order of cash. C. Order of time. D. Order of sales. Answer, C. 13. The cost of debt capital is calculated on the basis of A. Net proceeds. B. Annual interest. C. Capital. D. Annual depreciation. Answer, B. 14. N underscore 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 would be an example of a principal, while a n underscore 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 would be an example of an agent. A. Shareholder, manager. B. Manager, owner. C. Accountant, bondholder. D. Shareholder, bondholder. Answer, A. 15. Degree of combined leverage can be obtained by A. EBIT and fixed costs / EBIT, total interest expense. B. EBT/sales. C. Sales/contribution x 100. D. Sales/cash x 100. Answer, A. 16. Match the following. List I, subject. List 2, area. A. Financial accounting 1. Entries in the journal. B. Financial management 2. Cost of capital. C. Management 3. Planning. D. Marketing management 4. Market research. 5. Cost. A. 1 2 4 3. B. 1 2 3 4. C. 3 1 2 4. D. 3 1 5 2. Answer, B. 17. Which is called as dividend ratio method? A. Dividend yield method. B. Debt equity method. C. Asset method. D. Equity method. Answer, A. 18. Return on equity ratio is computed as A. Equity/ROA. B. Annual net income/average stockholders' equity. C. Debt/equity. D. ROA/debt x 100. Answer, B. 19. Match the following. List I, items. List 2, features. A. Capital structure 1. Financial leverage. B. Dividend policy 2. Annual dividend. C. Marketing management 3. 4P. D. Stock 4. Current assets. 5. Fixed assets. A. 1324. B. 3421. C. 1234. D. 1432. Answer, C. 20. The relationship between the financial leverage and firm's required rate of return to equity shareholders with corporate taxes is given by the A. Y equals cost/sales. B. Y equals R0 plus D/E, 1, TC, R0, RB. C. Y equals equity/cost. D. Y equals sales/income. Answer, B. 21. Cost of preference capital can be obtained by A. KP equals EP/2/DE/100, 1, tax. B. KP equals EP/2/D plus 1/100 x 100. C. KP equals D plus 1/2 x 100. D. KP equals D plus MB N.P/N slash MB plus N.P/2. Answer, D. 22. Assertion, a high capital gearing leads to greater speculation. Reason, our proportion of equity share capital in relation to the total capital comprising the other securities is small, leading to capitalization being highly geared. A. Both A and R are true and R is the correct explanation of A. B. Both A and R are true but R is not a correct explanation of A. C. A is true but R is false. D. A is false but R is true. Answer, D. 23. Capital budgeting, actually the process of making investment decisions in A. Sales planning. B. Production process and style. C. Fixed assets. D. Current assets. Answer, C. 24. According to the concept of financial signaling, management behavior results in new debt issues being regarded as _____ news by investors. A. Good. B. Bad. C. Non-event. D. Risk neutral. Answer, A. 25. Factoring is A. Financial planning. B. Production plan. C. Cost of sales. D. New financial service. Answer, D. Step 4. Financial Management, Demo Test. 1. Indicate the correct code for the following types of decisions to be incorporated within financial decisions. A. Investment decisions. B. Financing decisions. C. Pricing decisions. D. Profit distribution decisions. Code 1. A. And B. Only. 2. A. B. And C. Only. 3. A. B. And D. Only. 4. B. C. And D. Only. 2. In case the profitability index of an investment is equal to 1, equals 1, the net present value of the investment will be 1, more than 1, and GT1. 2. Equal to 1, equals 1. 3. Less than 1, and LT1. 4. Equal to 0, equals 0. 3. For the following two statements of assertion, A, and reasoning, R, select the correct code. Assertion: a risk analysis of capital investment is the most complex and controversial area in finance. Reasoning: our capital investment decisions are based on estimates of future cash inflows. Code 1. A is incorrect but R is correct. 2. A is correct but R is incorrect. 3. A and R both are correct and R is right explanation of A. 4. A and R both are correct but R is not right explanation of A. 4. Acquisition of firms is the same as A. a merger, B. an amalgamation, C. a takeover, D. an absorption. Select the correct code. 1. A, B, and C only. 2. B, C, and D only. 3. A and B only. 4. C and D only. 5. Hypothesis for capital structure is based on which code of the following assumptions? A. Capital markets are perfect. B. Firms belong to equal risk class. C. There is 100% dividend payout ratio. D. There are nominal corporate taxes. Select the correct code. 1. A and B only. 2. A, B, and C only. 3. B, C, and D only. 4. A, B, and D only. 6. The formula, where P0 is market price of shares, E is earning per share, D is dividend per share, R is rate of return and K is cost of equity, for determining the dividend of the firm has been given by https://www.jagranjosh.com/imported/images/article/UGC-net-july-2017.jpg. 1. Myron Gordon. 2. James E. Walter. 3. Modigliani, Miller. 4. David Dowand. 7. Indicate the correct code for the following two statements of assertion, A, and reasoning, R. Assertion: A. Inverters in capital market now have higher inclination for investment in debentures. Reasoning: R. Debentures have active secondary markets now. Code 1. Both A and R are correct, and R is the right explanation of A. 2. Both A and R are correct, but R is not the right explanation of A. 3. A is correct but R is incorrect. 4. Both A and R are incorrect. 8. A firm earns return on investment at the rate of 20%, earning per share is 15 rupees, payout ratio is 50%, Cost of equity is 12%, the market price per share as per Walter's model is 1. 300 rupees. 2. 240 rupees. 3. 75 rupees. 4. 166.67 rupees. 9. Consider the below mentioned statements and state the correct code of the statements being true or false. Statement: A debt equity ratio of 2:1 indicates that for every 1 unit of equity, the company has raised 2 units of debt. Statement: 2. The cost of floating an equity issue is lesser than the cost of floating a debt. Code 1. Both the statements, I and 2, are false. 2. Both the statements, I and 2, are true. 3. Statement, I, is false and statement, 2, is true. 4. Statement, I, is true and statement, 2, is false. 10. Debt service coverage ratio indicates which one of the following? 1. Effective utilization of assets. 2. Number of times fixed assets cover borrowed funds. 3. Excess of current assets over current liabilities. 4. Number of times surplus covers interest and installments of term loans. 11. Authorized capital of a company is 5 rupees lakhs, 40% of it is paid up. Loss incurred during the year is 50,000 rupees. Accumulated loss carried from last year is 2 rupees lakh. The company has a tangible net worth of 1. 2 rupees lakhs. 2. 2.50 rupees lakhs. 3. Rs. 50,000. 4. Rs. 7,50,000. 12. Match the items of list 2 with the items of list I and select the correct matching. List I. List 2. A. Liquidity risk. B. Financial risk. C. Exchange risk. D. Default risk. I. Refers to the chance that the firm will be unable to recover its dues from its debtors. 2. Refers to the possibility of adverse effect on firm's assets, liabilities, and income due to movement of interest rates. 3. Refers to the firm's inability to pay its dues towards creditors. 4. Refers to the inability of the firm to meet its financial obligations on time owing to non-availability of ready cash. Code 1. I. 2. 3. 4. 2. I. 3. 4. 2. 3. 4. 3. 2. I. 4. 4. 3. I. 2. 13. Which one of the following is related to control function of the financial manager? 1. To negotiate with bankers for a loan. 2. To analyze variance between standard costs and actual costs. 3. To estimate the future cash flows from a proposed project. 4. To advertise the public issue of the firm. 14. A firm is currently earning 50,000 rupees and its one share has a present market value of 175 rupees. It has 5,000 shares outstanding. The earnings of the firm are expected to remain stable and it has a payout ratio of 100%. The cost of equity is 1. 10%. 2. 5.71%. 3. 100%. 4. 23.5%. 15. Match the items of list 2 with those of list I and choose the correct code of combination. List I. Credit rating agency. List 2. Year of establishment. A. Chrysal. B. Moody's Investors Service. C. Standard & Poor. D. Fitch Ratings. I. 1860. 2. 1909. 3. 1914. 4. 1987. Code 1. 4. 3. I. 2. 2. I. 3. 2. 4. 3. 4. 2. I. 3. 4. 2. I. 3. 4. 16. The statements relate to international financial environment. Denote the code of the statements being correct or incorrect. Statement I. Foreign exchange risk denotes the variance of domestic currency value of assets, liabilities, or operating income attributable to anticipated changes in exchange rates. Statement 2. Foreign exchange exposures denote the sensitivity of the real value of assets, liabilities, and operating income to unanticipated changes in exchange rates expressed in its functional currency. Code 1. Both the statements are correct. 2. Both the statements are incorrect. 3. Statement I is correct while statement 2 is incorrect. 4. Statement I is incorrect while statement 2 is correct. 17. Which among the following firms having foreign trade qualifies for financial assistance under the Market Development Assistance (MDA) scheme? 1. Having annual turnover up to 10 rupees crore. 2. Having annual turnover up to 20 rupees crore. 3. Having annual turnover up to 25 rupees crore. 4. Having annual turnover up to 30 rupees crore. Step 5. Financial management, self-check. Questions. Correct answers. 1. 3. 2. 4. 3. 3. 4. 4. 5. 2. 6. 2. 7. 1. 8. 4. 9. 4. 10. 4. 11. 3. 12. 3. 13. 2. 14. 2. 15. 3. 16. 1. 17. 4. Thanks for watching Fuzail Pro.